Michael, your favorite time of the month? Hey, mine too, man. I appreciate that. So my name is Joe Massey. I'm with Castle and Cook Mortgage. I've been a part of the York Castle Ironton team for, 14 years now. And I'm joined by our host, Mr. Lon Welsh, who is the founder of Ironton Capital. We're going to be talking about national real estate trends. So Lon, welcome. Thanks for having me on, as always, man. Great to see you.
Yeah, thanks for being here. It's always great to do this. I'm going to dive into it. Last month, we didn't have enough time to get to the apartment updates. So I'm going to start with the apartment updates this time, and then we'll rewind back to consumer confidence, and we'll see how far we get today.
That sounds great.
So I just saw this chart a couple days ago, and I thought it was super interesting. It just shows the metro areas that have got the most office to apartment conversions in progress. And no surprise, New York City, with this massive office market, has about 8,000 units. But if you take a look at this collectively across all of it, it's like there's 70,000 units. So if you think about the overall apartment market having tens of millions of apartment units, the incremental impact of office to apartment conversion is not going to make a material impact in the supply and demand dynamics. For those of you guys in the Denver market, Denver is ranked number 15, so pretty active, almost 1,400 units in process.
And this is just, I do have a question. This is not building conversions. This is, if I have a building I'm making 50 apartments, that would be 50 of that 1,398.
Yes.
Is that right?
Yeah, exactly. So the 1,400 you see there for Denver, that's probably like 6, 8 office buildings.
Cool. But still, that's better than 0, which we saw for a long period of time.
Yeah. The vast majority of office buildings don't have the correct geometry to be converted. It's too much of a distance from the elevators to the windows. The max distance you could possibly get away with would probably be 35 feet, and 30 or 25 feet is more ideal. If you take a look at New York, it's not uncommon to have an office building the floor plate be an entire city block, like a couple of acres, and it's 100 feet from the elevator core to the windows. And, there's just not enough glass relative to the amount of square footage to be able to do a conversion. So the percentage of buildings that could even be eligible for this is a really small subset. So, but it's going to help some to take some of the capacity off the market. So if you guys have questions or comments as we go through, you should have a chat window on the right-hand side. Feel free to scribble in comments. I can't see them because I've got the full screen of the slide, but Joe can see them, and he'll read them off to me as we go.
Absolutely.
So if you take a look at apartment pricing, apartment price per unit is off about 20% from the peak in late 21. And if you compare that to the great financial crisis back in 2008 and 9, that was about a 30% correction. So looking at the stats, it appears that we've hit bottom dead center, and we've got a slight uptick, not only in apartments, but also in retail and also in office. So some good news there. So looking at what's going to happen next with apartment building prices, despite the enormous number of new apartment units that were added last year, and I'm going to show you a chart for that in a moment, the rents actually did have an increase last year. The areas that had the least amount of new supply added, like the Midwest, had a 3% rent increase, and the region with the most new apartments, the South, no surprise, since they had so much new capacity, they had a slight rent decline. But overall, it wasn't a bad year. We're expecting rent growth in 26 and 27 to be stronger as the number of new deliveries starts to taper off. And I'm going to show you a chart that will really illustrate that. 2 leading economic firms for forecasting that are RealPage and CoStar, and they're both sort of on board with about 3% rent growth this year and next. We are seeing that the amount of time that it takes to lease up a completely vacant brand new building has increased from an incredible 12 months in 2019 to more like 16 months now, but not too bad. I'm going to show you a slide in a minute that the concessions are up during this market cycle, but if you compare it to prior bear markets when the apartment market was struggling, the concessions are not nearly as high as they have been historically. And I think that's just the discipline of the market participants and having better software is a part of that. And then the overhang of vacancy isn't as severe either. What we are seeing is that the property managers are offering a lot of sweetheart deals to renewing tenants to keep them in place. If you're in downtown Denver, we're seeing as much as 12 weeks of free rent as an incentive for someone new to move into the building. And there's a fair number of people that will just apartment shop and surf from one building to the next as their leases expire. And it doesn't make sense for you to give 12 weeks of rent free to the next guy and have something vacated after only 15 months when maybe you get 4 weeks or 6 weeks of free rent for a renewal, just to make sure that people don't leave the building. Overall, the thing that's underpinning both the retail purchase market of owner-occupant homes as well as the apartment market is that we are undersupplied, in Freddie Mac's view, by 4 million housing units. There's a bunch of different economists that have all come up with their estimates of how much additional housing should be required. They're all in the multiple millions, so you can pick any number that you like. Any questions on that?
Nope, you're good.
All right, I'll show you a couple slides to back that up, but that's the real thing there. So the big headline takeaway from 2024 was the insane amount of absorption that we had. So absorption is just another way of saying, for the renters in the market, were there extra renters that could absorb or take some of the new capacity that was delivered? And the answer was it was a blockbuster year, somewhere in the range of 610 to 650,000 units got absorbed, which I believe is the best year that we've ever had. And it's the second best fourth quarter that we've ever had. Absolutely incredible demand for apartment units. So while we delivered an almost record number of units, we had a record amount of demand. And as a result, we were able to absorb almost all the deliveries, which no one thought was going to have happen. And the rents were able to go up a little bit last year. Just incredible. So this shows you the amount of new supply being delivered by year. So you'd have to go all the way back to the mid 1970s to come up with a year where we had almost 600,000 units delivered like we had in 24. This year, we're going to have a little less, like 450,000 units. And by the time we get to 26, you can see that it falls off a cliff. And the reason for that is that there's a 2 or 3 year lag time from when you announce that you're going to launch a project to when you actually get your permits, you break ground, you get the thing built, then you spend 16 months leasing the property up. That's about a 36-month process. And we can take a look at the new projects getting launched today and predict with perfect accuracy what we're going to see in 27 and 28 for deliveries. And you can see that it's like less than half of what we just delivered. I'm expecting we're going to have a recession, not a big one, a mild one, sometime in the next 18 months, and that will attenuate the amount of apartment demand for a period of time, but it won't last for long, probably 2 quarters, 3 quarters. I would expect that we're going to see more demand than supply over the next 36 months, and it's going to be a really good time for landlords.
Hey, Lon,
And
back on the absorption chart, Darren had a great question. Would that absorption rate have something to do with interest rate hikes? And I have my opinion, but I'd love to hear what you think on that.
Yes, I think that a lot of these people who ended up renting normally would have been first-time buyers, and the first-time buyers have been locked out of the market. But Joe, you are a lender. What are you seeing with first-time buyers?
Exactly that. Last year, first-time buyers segment made up 23% of transactions, which was the lowest on record. So there was fewer first-time home buyers as a percentage of the market last year than at any time that we've been keeping track of it. And I think that's exactly reflected here. I can't say a third of these people would have been buyers or half, but a large percentage of the people in this absorption in 2024 traditionally would have been first-time buyers, but instead moving out of mom and dad's house, they decided to rent because it's tough to buy right now. So I absolutely agree that interest rate hikes made an impact on this absorption.
Yeah, if you take a look at the number of absolute sales of resale homes, not new homes, last year for owner occupants, I believe it was the lowest number that we've had in 30 years last year. And if you compare the U.S. population now, which is 350, 360 million, to what our population was 30 years ago, it was probably like 70 million less. It really puts into stark contrast like how few units that we were able to sell to first-time buyers. So you said it was what, 24%?
23% was the first-time buyer market segment last year.
So typically the first-time buyer should be about a third. So that means that the market share of first-time buyers was 1/3 of what it normally should have been. So say 10%. Last year, we sold a little over 4.1 million homes nationwide. Typically, it would be 5.1 million. So if you take 10% on 5.1 million, it should be right around 500,000 more home sales we should have had last year that would have gone to the first-time buyer segment compared to historical that we did not have. And if you take a look at what was our absorption last year, 650, 700,000 units. So I think we could safely say that the majority of the absorption last year would have normally have been first-time buyers had we been in a more friendly environment.
I completely agree.
That's a great observation. I'm glad we got to do that math, actually. I probably should make a chart for that.
Yeah.
So this just shows you the amount of new supply getting added by quarter over the last 15 years, and then the amount of demand. And then the blue line is just the supply-demand balance. And you can see that we had a lot more deliveries than we had demand in 2022-23. And that's when the vacancy rate started going up. We started losing our pricing power. And then this year, we were able to pretty much close the gap. The amount of demand was very similar to the amount of deliveries. And that is this light blue line. If you take a look back to like 2021, when there was way more demand than deliveries, and that's why we had these huge rent increases in 20 and 21, you're going to see a shadow version of that in 26 and 27. It's not going to be quite as intense. So the rent increases are going to be more in the 3 to 5% range, not like in the 8 to 10% range, but the rent increases will be solid and all the units will be full. And it's going to be a very good time to be a landlord in 26 and 27.
I agree.
So why are we demanding so many units? And the reason is household formation is driving this. So I want you to think about this in that in a good economy, we create households. And what I mean by that is that you might have a young adult living in their parents' basement who's 23 years old, and they're able to get their first job and they make enough money. So they move out from their parents and they rent an apartment. So we've created a household. Another thing that you'll see happen is that you have, in a tougher economy, two friends living together in a 2-bedroom apartment, and the economy gets better and they can both get better jobs, making more money, and they decide they're going to get their own places. And when you go from one apartment, a household with 2 people to 2 households with 1 person each, you've created a household. So that's why we've had so much new apartment demand, is that we've had this incredible amount of household creation. And that's all really a function of strong wage growth and the fact that the unemployment rate is close to 0%. Mm-hmm. So net 800,000 young adults moved out of their parents' houses over the last 3 years. And that's a big part of what has powered this rental boom that as landlords we've enjoyed. So the thing I want to call your attention to, if you take a look at this blue line that bounces up and down, this is the current number that we have. There's 600,000, and that's a little bit above the dotted line. So it's probably going to be above the dotted line for another year or two. The dotted line is the long-term average. So you might ask, how many young adults are there in the 25 to 34-year-old age bracket who are still living with their parents? And it's an astonishingly high 16%, when historically like 12% is closer to the average. So if we went from 16% to 12% of these young adults living at home, that's 940,000 young adults, which would probably translate to 600,000 households. Mm-hmm. So if you rewind a couple slides here, if you take a look at the fact that in 28 and 29, we're going to deliver 400 new apartments, I can absorb 900,000. I could probably absorb 600,000 just from this age bracket all on its own. Mm-hmm. So we're going to absorb these things really quick. It won't be any problem at all, most likely. The thing that'll slow it down is the recession will, make that take a little longer than it ordinarily would. So I talked about this. Wage growth has been very strong and unemployment's been very low. So everybody has got the ability to afford rent, which is fantastic. So I want to talk about the concessions. So if you take a look at 2002 to 2006, we had 41% of apartments in America were offering concessions. And in the 2009 to 19 cycle, it was 28%, and currently it's only 15. So while we do have a little bit more vacancy now than we had, say, in 2020 and 21, the amount of margin we're having to give away as landlords from handing out concessions to everybody is less than it has been. And that's bolstered the financial statements of the apartment owners, which has been nice. So this just compares the number of new starts in a quarter to the number of new deliveries of apartments. And you can see not this most current quarter, but the 2 or 3 quarters before that, we had a very big imbalance where we were delivering a lot of units and not a lot of units were getting started. And now if you take a look at this, you can see the most current one, we've got almost no new apartment buildings getting started, and we're wrapping up our deliveries. So we're going to start knocking down the amount of deliveries. So this is just another way of looking at the chart that we had a couple minutes ago. Another way of looking at it, when are we going to be delivering these new units? 26 will be a lot less than 25. And then 27, 28, 29, very, very few new apartments are expected to get delivered. Yep. Let me just...
Let's do a thing for Mel so she can do her job.
Yeah, feel free to take that. No problem. So if you're curious about what the peak delivery month is by metropolitan area, this has got that for you. So for Denver, for example, the first half of 25 is the peak month. I'm sorry, peak quarter rather. So I won't go through this. You guys can get a copy of all these slides, but here's like a whole basket full of indicators that we like to track to understand where are the starts at and what's the leading indicators to understand where the number of new apartment starts is going to be. And all of them are pointing to there's nothing going on. I think the architectural billing index is the most important one because it's the longest lead indicator. So one last thing that people often bring up when I'm talking about this is, isn't there a lot of distressed commercial properties? Aren't they all going to hit the market? So if you take a look at the pink line here, that's multifamily, you can see that the 12-month rolling average here is about 2.5% of the large apartment loans are in delinquency. Oh, there we go. So despite the fact that there's a lot of negative headlines out there, it's not as bad as you think. What's really impressive to me is that if you look at the number of delinquent office loans, it's like 6%. It's not really that much more. Do you need to?
I'm sorry, I'm trying to get in so I can do the thing for Mel.
Well, that's okay.
There we go. Thank you.
You bet. Absolutely. Any questions on that, Joe?
No questions. I have a question for you though. You know, Ironton in some of the earlier funds, NDF 5, 6, there's some retail, some multifamily buildings. How does this absorption affect some of the earlier funds? I would think positively that they're being absorbed rapidly. And then how does it affect later funds like NDF, 9, 10, that maybe there's going to be less deliveries?
That's a great question. So for Fund 1, which was 2019, the apartment buildings that we built in 2019, like those were delivered in 2022 and they were leased up in 22 and 23. So didn't have any impact on us at all, really, as they're just operating assets. If you take a look at, say, Fund 5, which we launched in December of 22, the buildings that we're delivering there, let's say in Hill Point, for example, Hill Point is one of our biggest investments in Fund 5. We're building 21 different communities of about 300 units each. 5 are complete and they're in the lease up phase. And then the other 16 are in various stages of construction. A little more than half will deliver this year and the other half next year. So if they're in a larger competitive market like Jacksonville, Florida, or Charlotte, what we're finding is that we're seeing more like a 16-month lease up cycle instead of 12 months, not dissimilar from the national averages. Mm-hmm. So it's slowed down how fast we can get the building into production and then get to a refinance. Fortunately, with Hill Point, the majority of our buildings are in smaller markets where we're potentially the only large new complex under construction. So we haven't had as much impact there. It's really on a market by market basis. It's a really great question.
And it seems to me from all of this, it's still a good time to own multifamily residential. Would you agree with that?
Yeah, and actually, if you can get a project to pencil out now, there's almost no competition out there for new construction. So the contractors and the architects really need work. So they're being a lot more aggressive on their pricing than they were, say, 2 years ago or 3 years ago. And if you launch a new project now, you're not actually going to be putting it like on the market to be taking on new tenants until like 28. And there's going to be nobody competing with you. So this is actually like a really great time to be building.
That's what I was thinking. Cool. Thanks for answering that.
Yeah, great questions. So one of the things we're all really curious about is like, when can we sell our damn buildings? So, if I take a look at Fund 1, I made 8 investments. 5 of the 8 have been monetized, and the other 3 I still own. And I'm, it's 2019 to 2025. It's 6 years into what was supposed to be a 5-year project. We still haven't sold them yet. So we need to get to where we have a more buyer traction in the market so that we can sell these things and get a good price, because we're not going to give them away. So there's a number of quotes here showing that the buyers are starting to think that now's not a bad time to buy. I think it's fear of missing out, that they see that the supply-demand economics look really favorable. 26 will be a good year. 27, 28 are going to be really strong years. They need to buy now. So hopefully we'll see more sales this year. All right. I am going to start this from the beginning. Meanwhile, do you guys have any questions I should try to address?
We had one question. Tony asked if we would get a copy of the slides. That's a great question. The answer to that is yes. So the email that you registered with for the presentation, you will get an automatic email later this evening with a copy of the recording and a copy of the slides. And of course, always reach out to Lon, reach out to myself, reach out to any one of the folks. If you have individual questions, we're always happy to chat about that after the presentation. So great question, Tony.
Absolutely.
Lon, go ahead.
So let's talk a little bit about consumer confidence. So for those of you guys who are realtors on the owner-occupant side, or if you work with smaller investors like 1 to 4 unit rentals or fix and flips, this is an important leading indicator for you. So the lead thought is that headlines do more to terrify than clarify. Consumer expectations have just fallen down into the friggin' dungeon as a result of this negative nonstop news about tariffs and everything else that's going on. So the University of Michigan does the Consumer Confidence Index that you see quoted once a month across all the national headlines. So on the 11th, 4 days ago, we got the latest revision for the March stats, and you can see that the Consumer Sentiment Index right now is about as bad as it has been in the last decade. And if you ask, what are your expectations over the next year? Do you feel good or bad about the economy? We're at the worst number that we've seen in a decade. It's hard for people to get excited about committing to buying a car or buying a house if they feel really bummed out about the economy. So this is not a good leading indicator for us. We need to get this negativity out of the headlines, and then about 90 days later, people forget about all of it and they'll get back to being in a good mood. But for the moment, it's going to put a real dampening effect on the late spring and early summer. So you could ask consumers, how do you feel about selling your house right now? Is this a good time? And this is an extra a month old. I haven't gotten the new data. I don't think they ask it every single month. But in February, it was on the lower end of the range, as opposed to if you take a look at 2021, which was just like an amazing time to be a seller. You can see how in the stratosphere the optimism was about selling a house during that time period. So if you look on the right hand side, you've got the home purchase index sentiment, and that's pretty negative right now. And I would wager, like, if we weren't, well, this is April, so that's the latest one. It's probably going to look a little bit less attractive even than that when the next one comes up. So why do people feel bad about the economic outlook? And inflation, I think, is the cornerstone worry that all of this is getting built upon. And I think that's probably not unwarranted. If the tariffs stay in place, prices will in fact go up, and that will in fact drive inflation. So the consumers are being rational here. So most of the consumers feel that they're financial situation a year from now will be considerably more negative than it is today. And that's from April 11th. So this is really fresh data. And if you think about what's your expectation over the next year for your situation, it's also similarly pretty negative. So the reality is that before we got into this tariff hurricane recently, we had made some really incredible progress on inflation. You can see that from March of 22 to February of this year, we'd cut the inflation rate in half. Hopefully we get a swift resolution to the tariffs and we don't see some huge spike there. Any comments or questions on that?
No questions, but I like what you said there. The reality is things are actually improving from an inflation standpoint, but a lot of people are worried about it from a couple of slides before. And that leaves people to just sit on the fence or worse, sit on the sidelines. And I think we're experiencing that. You're not seeing as much activity. Real estate agents on the call, I'd be willing to wager they're not doing as many showings. Their listings are not getting as much traffic because people are just kind of sitting and taking a wait and see approach.
Yeah, absolutely. It's a little frustrating.
Yeah.
So the number of potential movers, and this is as of January 24th, so this data is a little bit out of date. Hopefully, I think this is a quarterly. We'll get a fresh one by the time I see you next time. The number of people thinking about moving their primary residence in the next 12 months had spiked up from around 14% to 18%. Unfortunately, a larger percentage than usual of those people were renters and not buyers. And that kind of gets back to what Joe was talking about 10 minutes ago.
Can I pause you there, Lon?
Yeah.
Gail had a question. Besides tariffs, do you think there are any other crises in the government that are going to have an effect on real estate?
Method that Doji has been using to affect reductions in government spend, which supposedly adds up to like 150 billion a year. So it's a pretty significant set of cuts. I think it's going to have a lot of negative downstream consequences, but I don't think you're going to see those for a year or two. And when you do, I don't know if you'll see it show up in inflation. It'll be service delivery failures in lots of subtle ways. Like an example might be like the National Weather Service has had some really large reductions in staffing. So they may not be as able to predict like hurricanes or tornadoes as they have in the past. I don't know if this is exactly true. I'm just trying to think of an example in real time here. Mm-hmm. So the number of adverse impacts from large storms might be larger in the future than has been in the past. And, that might mean that more people die in storms, for example. But I don't think you're going to see any of that stuff percolate all the way through the system for a little while. Overall, I don't know. I don't know if you're going to see it happen in terms of like negative impact on the metrics we've been looking at. But Joe, what do you think?
I think the only one that I might be able to make a little bit more of a direct correlation would be immigration policy, because a very high percentage of construction workers are immigration or immigrants rather. And I think it's upwards of 60%. And if a large percentage of those folks begin to leave the country, that would impact the cost of workers to build new construction properties. So I think two things there would be tariffs might impact the cost of materials, and immigration policies might impact the cost of labor. And both of those may drive up the cost of new home construction. So those would be probably the two most direct correlations. And we already have affordability challenges, particularly on the lower end for new starter homes. And I think that might exacerbate the issue.
Yeah, I agree with all that. That totally makes sense to me. On the positive side, if we can see a tax bill that gets passed that doesn't increase the deficits, and maybe we really get lucky and like they come up with the tax package combined with these spending cuts that reduces the size of the deficit compared to the trend we've been on, that would be incredibly favorable news. We'd probably see the 10-year Treasury go down a little bit, and that is the index that the mortgages are based on, and maybe we'd see some mortgage rate relief. I'll be really curious to see what the House and Senate come up with on that.
I agree.
There's discussion about raising the highest marginal tax rate, which would raise quite a lot of money in the 300-ish billion per year range. So if they, if you could cut spending by 150 billion, which supposedly is the number, And if you could raise taxes like 350 billion, that'd be a half a trillion a year less deficit. That might be enough to move the dial. I mean, you might see the 10-year really come down. That'd be really great for the economy.
Yeah.
We'll see. Unfortunately, I'm probably in the tax bracket that's going to see the higher tax rate, but alas, can't win them all. So if you ask a bunch of economists how many resale homes are we going to have sold in 2025, the consensus view is that we're going to sell 10% more than we sold last year. I'll buy you a bottle of wine if that's true. I don't see it happening. I think it's going to be flat a little bit, maybe up a little, but up 10% seems like a lot.
I agree.
Will prices drop? So this is the last 6 recessions, and you can see that the price declined only one time on a material basis, and that was in 2008. And that's because the great overhang of homes and the number of foreclosures that we had in 2008 and 9 was so huge. That's what drove the 20% drop. And the recession was a side effect from the real estate fiasco. Other than that, you don't usually see home prices go down during a recession. They're usually just up modestly. And Joe, tell us a little bit about what happens to mortgage rates during a recession.
Yeah, when you exit a recession, mortgage interest rates go down. That's one of the ways that that fiscal and monetary policy can help get out of a recession, is by decreasing long-term interest rates. And if you look at the 3 most recent recessions in 01, 08, and 2020, I would expect to see the same or maybe a little bit better, between 1 to 1.5% improvement in long-term interest rates if we were to go into a recession this year, which again, that percentage has increased from 15 to maybe 35%. Could be really positive that home prices may still go up, 1 to 4%, and interest rates may go down between 1 and 1.5%. Could bring some relief to buyers that are challenged by affordability right now.
So Joe, just to sort of refresh the listeners here, if I'm a typical couple with great credit buying a conforming size house and I'm putting 20% down, and what kind of rate would I be looking at today?
As of today, would be right at 6.9%.
So, to knock a point off that to get to 5.9, that would really help a lot.
That would make a big difference for 2 reasons. It makes a financial difference, and it makes a perception difference.
Yes.
There's no way to measure that consumer confidence of what are the things that are upsetting people, but seeing high 6s and low 7 interest rates, I guarantee that's one of the things that goes into that consumer confidence number that makes people feel less confident.
Yeah, there's no doubt. No doubt. So our price is going to go down. I don't think they're going to go down in any material sort of way overall. Not illustrated on this chart, but what we're seeing in Denver is that condo prices have gone down a little and detached houses have gone up a little. And I think that trend is likely to continue. The condos are usually the first to run on the ladder for a first-time buyer. And as we talked about, the first-time buyers are a little bit less active in the market than you'd expect. Overall, Joe, can you tell us a little bit about the value of home equity right now and kind of where we're at historically?
Yeah, well, there's more home equity right now than there has ever been in the history of the United States. And if you were to go back and look at the 2008 crisis, many homes and as a nation, we were actually upside down, that we had more debt than we did equity. That's what led to a lot of foreclosures. Now we're in the exact opposite position. We have more than double the amount of equity than we have in debt. So we're not going to see prices crash as a result of a foreclosure boom, because even in good times, or if we have a recession, when people lose their jobs, if they've got $100,000, $200,000, $300,000 of equity, what do? They call one of the real estate agents on the call and say, I need you to come sell my house because I need access to this cash as soon as possible. They're not going to just put their head in the sand and give up $100,000, $200,000, $300,000 of equity. So investors on the call who are hoping for a foreclosure boom, probably not going to happen, because way too many people have way too much equity.
Yep. Yeah, that's going to provide a strong backstop, I think, to the overall home pricing system. It takes a little longer to sell homes this year versus last year. That's probably not new information to anybody on the call. What was new information to me when I got this chart, though, is that it's 5 days longer. So for those of you with prospective sellers who have some reluctance about listing because they perceive the market conditions are really adverse, and we saw that one of the first consumer confidence slides, there's a lot of people who feel that way. I think this is a good fact-based chart to say, yep, you're right, Mr. Consumer, it does take longer to sell a house, 5 days longer. Is that okay? And it's not as bad as they probably think it is. I think the other factor putting a lid on potential price appreciation over the next couple of years is just the DTI ratios. And Joe, can you tell us a little bit about what this means?
Yeah, so debt to income is the amount of money that you're spending on your housing expenses versus how much money comes in. And you can see in January of 2021, we were near record lows with the average of 13% of a consumer's income being used on their housing expenses. That is now more than doubled. That we're up to 27% of the average consumer's income being spent on their housing expenses. And that's actually a factor of like 5 different things. Number one, home prices are up, interest rates are up, insurance is up, taxes are up, and HOA dues are up. So we're getting hit like in 5 different ways if you're a buyer. And that's leading to folks that maybe wanted to buy a $500,000 home are now having to look at maybe a $300,000 home. And then they're hit with a challenge that there's not that many $300,000 homes. So this is going to be a challenge. And I think this is a good leading indicator from what you said earlier, Lon. We're not going to see 20% home price appreciation. We're probably going to see 1, 3, 5%. And that's going to allow wages to catch up over the next couple of years as we work our way through this cycle. And then hopefully we'll see on the far right-hand side, this DTI level begin to come back down as people make more money and as we get some relief from high interest rates.
Yep, I love it. This chart, I think, really explains a lot about where things are going. And we talked a little bit about where the rates are at. I think we've do you want to talk about this, Joe? This is my favorite quote. I don't think we've talked about this.
Yeah, in 1971, the interest rate for a mortgage was 7.33%. So not far off from where we're at today. If you waited for interest rates to go down, you would not have purchased a home until 1993. You would have rented for 22 years while you waited for rates to go down. Meanwhile, the value of real estate quadrupled. Don't wait to buy real estate, buy real estate and wait. And I think this is really ties into that apartment absorption that we saw and the low number of first-time home buyers, right? We've looked at DTI. It's hard to buy your first home right now. Homes are less affordable than they have been in recent memory. But this is a quote that we really need to share with our younger buyers. We need to share it with our experienced clients that maybe have young adults living in their homes. This is a great way to remind people, if you're waiting for rates to go down, you might wait for a really long time. And when that does happen, home prices are likely to be much, much higher. So buy today, work with us. We'll show you some ways that you can minimize that monthly payment, and you're still going to be able to take advantage of that appreciation and equity growth. I absolutely love this stat. I can't remember where you found this, but this is a really, really great one to share with younger buyers and our experienced buyer that have young adults living with them.
Yep, it's really tells the whole story that we need to tell.
Yeah.
So do rates impact the market? So you can see appreciation in the Denver market has slowed down quite a bit to 1.5% in last year. And you've got some other major markets here. Pretty much everybody was up other than Tampa. Tough year for Tampa. Usually increasing mortgage rates predict lower sales volume because of affordability. So there's a blinding glimpse of the obvious, but there's a couple charts here you could study that really prove that. The higher rates, if you take a look at the days on market, have influenced the amount of marketing time. As we just saw, it's only like 6 days more marketing time on average. And there's a little bit of variation from one market to the next of how much it's impacted things. So, Joe, can you talk about this slide? I think this is the lock-in effect that people have worried about. It's becoming less of a problem over time, but what do you see with this?
Yeah, so that dark black or dark blue line that is really low until 2020 and then goes really, really high, that is the number of people that have mortgages below 3%. And if you're an agent on the call, I'll bet you've had a client say, I'm never selling my home because I have a 3% mortgage rate. I'm never moving. Well, I think that that's true in the short to medium term. And this chart really represents that. If that were true for the long term for every client, that black line would peak there at 35% and then would remain perfectly flat, that those people are never selling and never moving. But what you see is that 35% of people that had rates less than 3% over the last 3 years, that's actually decreased by 10%. And now there's only 25% of people with mortgages below 3%. What that means is life goes on. People get married, people get divorced, people get relocated for jobs, people have children, people have an aging parent and they need more space. All sorts of things occur in the mortgage and real estate market that, I don't want to say force people to sell, but encourage people to sell because life goes on. Now, this is really a good thing for us on the call because it's freeing up more inventory and it's giving more opportunities for buyers when there's more inventory on the market. Now, the other actionable piece here is when you have somebody say, I've got a 3% rate, I'm never selling my home, that doesn't mean take them off your list. You want to keep them on your contact list. You want to remain in flow with them because sooner or later they may have a lifestyle change that's going to require them to make a housing change. So I love this because you're seeing that chart come down, and that is the indication of that lock-in effect is kind of freeing up. So I think this is a positive thing for all of us on the call.
Absolutely. It drives more transactions. And this is the number of people with less than 3% going from 35 to 25%. This happened way, way faster than I would have ever forecast. What do you attribute that to?
Life goes on. I don't have a good answer.
Yeah, I think that's it.
Yeah, other than things happen. And I mean, you see there that peak is flat right at 35% for only about 6 months. And then things happen, life. People transact for real estate while we're really numbers focused and data focused. By and large, the people on that buy and sell real estate do it for their personal reasons. I need a better school district. I hate my kitchen. My backyard's too small. Like, those are the emotional reasons why most people buy real estate. And I think we can get a little bit of tunnel vision and forget that, because I feel the same as you. I thought that would stay really high for a really long time. But by and large, people buy real estate for emotional reasons. Financial reasons are the second reason why they buy. And so I think this is just a good reminder for the salespeople on the call. Make sure you're staying in flow with your people, because even though they have that 3% rate, they may have a young person or a child that's in the wrong school district and they have to make a move. You want to stay in touch with those folks.
That's great advice right there. So what's the forward pipeline look for purchase activity? So on the left-hand side, Joe, this is people who are applying to get a mortgage from you, right?
That's correct. Yep.
So you could see that blue line had been at record lows at the early part of the year. But recently it's better than 24, and it's actually approaching 23. The first time it's done that in quite a while. So I was really encouraged to see that despite the fact that rates are like 6.9%, people are applying for a mortgage. So that's great news.
Yep.
Exactly. And then, Joe, what's going on the right-hand side?
Yeah. So on the right-hand side, this trails the left-hand side by about 30 to 60 days. What you see on the left-hand side, that is somebody getting pre-approved for a mortgage. They go out, they shop, they look for homes, they get under contract, and at that point, they can lock in their interest rate. So on the far right-hand side, that's just trailing a little bit because you have the application, shop for homes, then lock your interest rate, and we are seeing that up to better than 23 and 24 levels, which is a really positive sign that we're going to have a decent spring. Nobody's going to kill it with 50% transaction growth, anything like that, but we're setting up for a pretty nice spring, better than we had the last 2 years.
Yeah, that's really encouraging. This is way better than I expected the numbers to be, given how high the rates are and the degree of pessimism out there in the market. This does, I think, lag, though, people's sentiment by about 60 days. So you'll probably see the current negativity of consumers hit these purchase index and rate count locks in 30 to 60 days, I'd guess.
I think if you go back one slide, I think that blue line on the left, when you guys come back 30 days from today for our next presentation, I think that blue line on the left will be back closer to that yellow line and the 2024 numbers. With the real-time data that I track based on the number of applications that we're taking here at Castle & Cook, I think you're going to see that come down based on all the way back to slide number 1, consumer confidence.
Yep, I agree with all that. I do think we're going to resolve the majority of these tariff things within the next 30 to 45 days. I don't think this is going to drag out too long. And hopefully this will be in the rearview mirror by the time we get to third quarter.
I agree.
Do you want to talk a little bit about this slide, Joe? There's a lot of interesting stuff to unpack on this.
Yeah, the left-hand side is the refinance index, which we did see a spike in that just recently as interest rates took a dip for about 10 days, and now interest rates have gone back up. So we're going to see kind of a jigsaw sawtooth pattern on that blue line when you guys come back in 30 days, that refinances are going to go back down. But then on the right-hand side, the number of folks that are rejected or turned down for refinance is at almost an all-time high over the last 15 years. Nearly 45% of people get turned down for a refinance. And I'll give you an anecdotal story. I closed on a refinance for a gentleman 3 weeks ago. He had an 812 credit score. He was borrowing 65% of his home value. He had less than 30% DTI, probably $300,000 in the bank. He applied with me, and he applied with an online mortgage lender. And the day he closed with me, he received in the mail a decline notice from the online mortgage lender. And he asked me, he's like, "Are you sure my loan's good? Because those guys turned me down." And I would never say anything negative, but I said, Mr. Client, I think maybe they're just not that competent. So the moral of the story, if you or one of your clients gets turned down for a refinance or a purchase loan, have them give me a call or have them reach out to your preferred mortgage lender, because we are seeing, I hate to say it this way, but lender incompetence is leading to some of these loan denials. It's not necessarily that the client is a bad client, but they might just be working with someone who doesn't know how to get it approved.
Wow, that is really interesting.
Yeah.
I would have thought that, we're at a record balance for a number of credit cards. We're at a multi-year high for the number of credit cards that are delinquent. We've got a huge number of households that report that at least one of their bills didn't get paid in the last 30 days. I would have thought those would have been the drivers, but apparently it's just something even as basic as, I guess they had to fire everybody in the last 2 years. They're probably running very, very lean out on their staffing. And now that you've got a spike in applications, nobody knows what to do. So they're probably just cherry picking the best ones and throwing everything else on the floor.
Yep, exactly.
Huh. Interesting. Showing traffic this year has been less than prior years. I think the overall number of showings is relatively static, but since there's so many more homes on the market to look at, the showings per listing goes down. So, to only have 6 showings is not really a whole lot. So if you're a listing agent, you're probably already doing this, but just as a reminder for the newer realtors on the call, every showing matters. You want to really coach your clients that they've got to just go the extra mile every single time, because there's just not going to be that many showings.
Yeah, we did get one final question here. How is the luxury market doing right now?
It's slowing down. So there's a lot of consumer confidence in the luxury segment that is tied to people's sense of wealth and well-being. So when the stock market is raging, it's easy to get your quarterly statement and say, gosh, I've got 150,000 more than I had during my last quarterly statement. I should, be a little bit more inclined to go buy a Lexus or buy a luxury home. And right now, the stock market hasn't been doing all that great, and the amount of volatility in headlines is just off the hook. So I think a lot of people are saying, no one needs to trade up from a 5,000 to a 7,000 square foot house. It's always something you can put off.
That's right. And Lon, great information as always, man. Really appreciate you putting this together for us.
Thanks for doing all the color commentary to help bring some of these slides to life. You've got a totally different view of the market than I do, and the two of them together really make it a 3D image.
All right.
All right, guys. Well, thank you so much for your time. I really appreciate having everybody here, and we'll see you in about a month.